Hey everyone, welcome to TH Academy. Hope you guys are fine. If you are studying economics, business, or finance, today's topic is absolutely essential. We are going to discuss fiscal and monetary policy. So, basically, these two policies are the main tools that shape every economy in the world. They control everything from the prices you pay at the store to the number of jobs available. So we will break down who controls each one, what tools they use, and how they fight off problems like recession and high inflation. So let's get started with the first slide. That is, what is fiscal policy? Okay. Let's begin with the fiscal policy. Think of the word fiscal as meaning finance or budget. So this policy is all about the government's money. If we talk about the definition of fiscal policy, the fiscal policy is the plan the government uses to manage its spending and its revenue, which mostly comes from taxes. That's why it is also called budgetary policy. The main goal is to keep the country's economy stable and growing. It's aimed for things like full employment, making sure everyone has a job, and ensuring income redistribution, making sure wealth is spread fairly. Now, who is in charge? It is the government itself, the Prime Minister, the President, the Finance Minister, and the Parliament or Congress. If we talk about the tools of fiscal policy, the government has two levers. It can pull to influence the economy. Government expenditure, the first one is government expenditure and the second one is tax. Government expenditure means government is spending. So basically this is the money the government spends on two different types. First one is development spending, means buildings like new roads, schools and hospitals. This creates job instantly and boosts the economy. They also spend on non-development costs like paying salaries and running day-to-day operations. Second one is taxes. Taxes are the revenue the government collects. They use taxes not just to raise money but to change behavior. For an example, import and export duties can help stabilize prices in the country. Also, progressive taxes, where richer people pay a higher percentage, can help reduce inequality between two different groups and regions. So these are the two tools of fiscal policy. Now let's talk about the types of fiscal policy. Fiscal policy can be used in two opposite ways, like depending on what the economy needs. First, first type of fiscal policy is expansionary fiscal policy, and the second one is contractionary fiscal policy. So let's talk about the first one, that is expansionary. The word expansionary means to make something bigger. The government uses this when the economy is slow or in a recession. The government will increase its spending and decrease taxes. This gives people and businesses more money, which boosts demand. The goal is to fight unemployment risk. This spending can create a budget deficit, forcing the government to borrow money and increase the national debt. Second, contractionary fiscal policy. So the word contractionary means to slow things down. The government uses this when there is too much money chasing too few goods, leading to high inflation. The government will decrease its spending and increase taxes. This takes money out of the economy, slowing down demand and helping to reduce inflation. So this is basically our fiscal policy we just already discussed. So now let's talk about the second policy, that is monetary policy. Here we go. Now what is monetary policy? Now let's move to the other key player. This is completely separate from the government's budget, right? So if we talk about the definition, so monetary policy is the plan to manage the total supply of money and credit in the economy. It's primarily managed by controlling interest rates. The central bank's number one goal is price stability. That means keeping inflation under control. By managing interest rates, They influence how much you save, borrow, and spend. Now, who is in charge here? It's basically the central bank of the country. In the US, it's the Federal Reserve. In the UK, the Bank of England, and so on. So, if we talk about this state bank, that is basically the Central Bank of Pakistan, is usually independent of the government to ensure its decisions and purely economic. Now, let's talk about the types of monetary policy. Monetary policy has two types of actions. Basically, first one is expansionary and the second one is contractionary. Expansionary monetary policy, we can also say this as easy policy, and contractionary policy, monetary policy is also called tightening policy. So, the expansionary monetary policy or easy policy used to boost the economy and creates jobs. So, the central bank increases the money supply and decreases interest rates. Lower interest rates means loans for cars, homes, and businesses are cheaper, which encourages people to borrow and spend more. That's how they boost economic growth. Now, just like with fiscal policy, if they inject too much money, the big risk is high inflation. Now, let's talk about the second policy, that is contractionary monetary policy, used to fight inflation. The central bank decreases the money supply and increases interest rates. When borrowing is expensive, people spend less, which slows down the economy's demand and helps to bring inflation back down to a manageable level. So these are the two types of monetary policy. First one is expansionary and second one is contractionary. Now let's move to the next one, which is the tools of monetary policy. So here are the tools of monetary policy. The first one is open market operations, or we call it OMO. This is the most common tool. It simply means the central bank buys or sells government bonds. If they buy bonds, they put cash into a banking system, which lowers interest rates. If they sell bonds, they take cash out, which raises interest rates. Number second one is reserve requirement ratio, which is also called as RRR. So this is the percentage of money that banks must keep in reserve and cannot lend out. If the central bank lowers the reserve requirement ratios, banks can lend more money, boosting growth. So if they raise the reserve requirement ratios, banks have to hold back money, slowing down, leading and fighting inflation. Now, the third one is discount rate. This is the special interest rate at which the central bank lends money directly to the commercial bank. Lowering this rate encourages banks to lend more cheaply to you. Now, let's talk about summary of fiscal versus monetary policy. To wrap up, let's do a quick comparison that you can remember easily. Fiscal policy is the power of government using its spending and taxes to achieve goals like full employment. Whereas monetary policy is the power of the central bank using interest rate and controlling the money supply to achieve price stability and control inflation. So there are the two separate but equally important teams working together to steer the economic shift. So this is how we achieve our economic growth by applying these two policies, fiscal and monetary policy. So this is it for today. I hope you understand the whole lecture. Thank you for watching. I hope this explanation was clear and helpful. If you understood the difference between these two policies, please hit the like button, share this video with your friends, and subscribe to TH Academy for more easy to understand economic lessons. I will see you in the next video. Take care of yourself. Bye bye.